Welcome to the Scientific Sense podcast, where we explore emerging ideas from science, policy, economics, and technology. My name is Gill Eapen. We talk with world's leading academics and experts about their recent research or general areas of topical interest. Scientific Sense is an unstructured conversation with no agenda or preparation. We cover a wide variety of domains where new discoveries are made and new technologies are developed on a daily basis. We are most interested in how new ideas affect society and help educate the world how to pursue a rewarding and enjoyable life rooted in science, logic, and information. We seek knowledge without boundaries or constraints and provide unedited content of conversations with researchers and leaders who love what they do. A companion blog to this podcast can be found at scientificsense.com, and this podcast is available on over a dozen platforms and directly at scientificsense.net. If you have suggestions for topics, guests, and other ideas, please send them to info@scientificsense.com, and I can be reached at gill@eapen.info. My guest today is Dr. Fred Olayele, who is the Chief Economist and Head of the Economic Research and Policy Group with New York Economic Development Corporation. He oversees economic research and policy initiatives aimed at making New York City the global model for inclusive growth and innovation. He is also a research professor at the Sprott School of Business in Carleton University in Canada. Welcome, Fred.
Thank you very much, Jill. Nice to be here.
Yeah, so I want to start with one of your older papers, which is, sort of discussing a framework. It's entitled Economic Diversity and the Resource Curse, a dynamic panel model. And you say that the paper contributes to the debate on the impact of economic diversity and the resource curse on economic growth. And you use dynamic panel data models on data on Canadian and US subnational jurisdictions. Before we get into this, Fred, what exactly is the resource curse?
Well, thank you very much again, and I'm pleased to join you. This is an interesting platform, and I hope we can take a deep dive into some of these issues.
Sure.
Yeah. So the resource curse is just the paradox, that explains why certain countries and regions that are rich in natural resources, why they tend to have less growth, or let's say why they tend to have dismal economic performance compared to comparators or other countries or regions that do not have resources. And in the literature, it has become very popular to explain the cause, through both economic and political, institutional arguments.
Yeah, so in the paper you say, Fred, so the resource curse may be stated as it's a paradox that countries with an abundance of natural resources, so we are talking about natural resources that can be mined and so on, and they tend to have less economic growth than countries with fewer natural resources. So that is a paradox, right?
That's correct. Yeah, it's a paradox because, of course, in traditional economic discourse, when you look at the factors of production, it's very intuitive that regions that have more resources, inputs, say labor, capital, we'd expect that to help the production process, So if you think about natural resources as some form of input into the production process, how then do you explain the fact that regions or jurisdictions with a lot of resources have nothing to show for such endowments? So it's obviously a paradox.
And so they grow slower compared to other countries. And you say there are a couple of explanations or attempted explanations for it. One is an economic argument, and the other is a political institutional argument, right? So what is the economic argument for that?
Yeah, so the basic economic argument for the resource cost is what economists call the Dutch disease. And the Dutch disease is basically a situation where you have a diminished manufacturing sector.
Yeah.
As a result of the crowding out effect of the extractive sector.
Okay, so it's a bit like if you have a country with a lot of copper, a natural resource, all the sort of the focus of the country is going to be mining out copper and not really manufactured goods out of copper. They probably typically just sell it, right, to somebody else.
Exactly, yeah. They tend to focus on the resources, and then because of the low productivity that comes with primary goods, it's often very hard to leverage efficiencies and high productivity that comes with high value adding production. Yeah. So we think about this, from like a small open economy model, like we say in economics. When you're looking at an open economy model, you find out that a non-tradable sector, which is typically a service sector, the nuances of what you see there will be different than a tradable sector where services or their output, can pass through processes that can enable you to trade those.
Okay. And so that's the economic argument. You cite a few papers here. There has been a lot of studies around this. And it sort of makes intuitive sense when you have a lot of mineral-rich deposits and so on. That's what you focus on, but it is in exclusion of other things that the country could do. So that's one explanation. The other explanation is the political institutional explanation, right? So what is that?
Yeah, it's actually very interesting, and before I actually talk about the political institutional dimension, I will quickly say that the whole notion about the resource cost is actually caveated, there are caveats, because the pioneers in this field, Sachs and Werners, back in the day, their seminal paper, was very well received in the literature. But over time, you found that other researchers came up to contend that in actual fact, there are many other factors that can serve as the transmission mechanism for the cost.
Right.
So look at countries like Botswana in Africa. You look at countries like Canada, these are countries with a lot of natural resources.
Right.
Yet they have a lot to show for the resources in terms of well-being, in terms of growth, and what happens. And when you look at the poster countries for the resource cost, like Nigeria, like Venezuela, like other, resource-intensive economies, you find that they don't have a lot to show for it. So in a way, there is some sort of a conundrum. So we always like to put a caveat that the political institutional channel explains why some countries are successful where others, fail to make significant leaps in terms of shared prosperity and moving their citizens out of poverty.
Yeah, that's interesting. So what you're saying, Fred, then, it's not an automatic thing. We can see some countries, like you say, Canada doing pretty well. Some countries like Venezuela not doing that well. And so just the economic argument doesn't necessarily hold good for the entire cross-section. So that's why the political institutional dimension might be important, right?
Yes. And I can even go further to say that when you talk about the political angle, the institutional angle, then you start to look at the importance of institutions in regions and jurisdictions where you have strong institutions, and then you find that those institutions are able to inhibit, or lessen the rent-seeking behavior that you find from lobbyists and other agents that are not really contributing to the real sector. So a very nice way to summarize the political institutional argument is that in jurisdictions where there are strong institutions, like in Canada, like in the United States, like in Australia, like in Botswana, you find that they are able to make significant leaps, and bounce through their resources because you have those institutions helping to really, reduce corruption and other wastages. But in regions where institutions are weak, say because of corruption or civil wars or dictatorship and what have you, then it becomes very hard to escape the cost.
Right. You also say, though, I think this is another paper by Ross. You say while corruption and rent seeking are less prevalent in developed countries compared to their developing counterparts, Ross cautions that resource-dependent jurisdictions may tax their residents less heavily, and in turn, taxpayers maybe indifferent to politicians' accountability and representation. And so there could be cases where we don't expect a lot of corruption, but it might still act in that fashion because people don't really care.
Absolutely, and that's the very interesting thing about this whole paradigm. In the early days of the model, a lot of focus, a lot of attention was really on cross-country analysis. But over time, researchers, and scholars in political economy and development have begun to look at subnational data, So researchers have tended to look at states and provinces, to see what insights, could be shared. And then you find that in subnational jurisdictions, especially in the developed world, find that jurisdictions that are really resource abundant tend to be complacent when it comes to taxes and other revenue generating activities. In fact, in certain jurisdictions, you see policymakers and politicians, not really, maybe charging some taxes and other things.
Right.
And also see the notion of heritage funds or sovereign wealth funds, which are created to help mitigate the effects of shocks, during exogenous shocks. So the summary of my argument there is, when you look at subnational analysis, there is a tendency for some of these jurisdictions to not be too aggressive when it comes to generating revenue from tax, and over time, it's become a pattern, that when the boom happens, there's a lot of relaxation. But when there's a burst, everybody's back on the table, what interventions can help to balance the budget.
Right. And so you then in the paper connected with economic diversification. And so export diversification is associated with higher long-run growth. However, resource exporters are different in many dimensions, and these differences will shape diversification priorities and policies. So talk a bit about what you mean by diversification and how would you measure that?
That's a very good question. And I'll just start by saying economic diversification is perhaps one of the most recurring themes in public policy debates. When you look at economic theory, competitiveness is the outcome of specialization through trade openness. And if I go back to theory, I think about the neoclassical theories and, other models that have really explained the concept of comparative advantage, which is a basic framework for understanding how specialization and trade patterns, account for productivity differences. So the way to think about diversification is that the returns to economic sectors are often highly variable, with varying degrees of risk and costly adjustments to consumption. So this explains why too little diversification could be risky. And in fact, you will find that most policymakers cannot just afford to take their eyes off diversification, despite the many benefits that come with the opposite of diversification, which is specialization. So we often talk about the concept of the efficiency arguments that come with specialization. But my point here is, despite the efficiency argument for specialization, diversification has become a major tool that enables policymakers to mitigate the effect, the impact of economic shocks. And this has major implications for the real sector. And more broadly for policy, to the extent that the employment and output mix can help to lessen the impact of economic vulnerability.
Yeah, so it's very interesting, Fred. So in the paper, you are trying to connect what we discussed first, which is the resource curse problem. So you have some proxy for resource endowment for a country, such as mining as a share of GDP or mining as a share of total employment, perhaps. And then you have some control variables such as educational attainment, maybe some capital stock, endowment, and so on. So what I think, if I understand this correctly, what you're trying to accomplish is to ask the question: how do these two things interact with each other? These two things, meaning the resource curse that we discussed, and then specialization or diversification, economic diversification. How do these two things interact with each other? And then what implications they might have for policy, right?
Yeah, that's correct. That's correct. Very well said. So in economic modeling, we often talk about control variables,
Yeah.
So when you are trying to model a scenario, you include certain variables to serve as control. So in this paper, what we have done is really to include educational attainment, as a proxy for institutional quality. And when you look at educational attainment, in fact, you have very robust discussions and a lot of papers that have really laid the foundation for the role of education and skills, and knowledge and innovation in the production process. What that means is educational attainment is included in our model to help to capture, skills and other qualitative aspects of the stock of human capital.
Right.
The other control variable, of course, is physical stock.
Yeah.
A number of researchers will interpret physical stock, by maybe infrastructure or investment, or other important variables that in essence capture what we call capital accumulation, So in the model, you are taking capital accumulation and skills, Those are two important variables that not only serve as controls, but they are also very good proxies for institutional quality. And barring any causality or endogeneity, you can safely conclude that regions that have high educational attainment and quality infrastructure tend to also rate very highly, on the economic performance spectrum.
Right. And so if growth is the variable that you're trying to estimate, you have you have resources, you have educational attainment, you have infrastructure. Some of those are control variables, and basically asking the question: can we actually find a relationship between growth and the resource richness of the country, right? So what did you find in terms of conclusions from the study?
Yeah, so I'll put it this way. There are two arguments, there are two basic research questions in the
Yeah.
paper. The first question is uh, how does resource endowment impact on growth? What's the relationship between resource endowment and economic performance?
Yeah. So if you just look at resource curves, we would anticipate a negative relationship,
Yeah,
but
that's
yeah, but if
correct.
you can, yeah, go ahead.
Yeah, that's correct. So that's the first leg of the argument. We
Yeah.
try to first establish the presence of a cause.
Yeah.
And after doing the modeling and simulations, and then we jump to the second argument, which is if there's a cause, to what extent does the presence of institutional quality, or to what extent do strong institutions prevent the prevalence of the cause? And that's actually the more interesting question in the research, because step back a second and look at the data. I'm not looking at countries in the global south. I'm concentrating on two developed economies, Canada and the US. So a lot of things are already taken for granted. Canada and the United States are two of the most advanced countries on the planet. So, but when you look at them from a subnational perspective, my question then is, how do we look at uh, certain subnational characteristics, that vary significantly between both countries, despite their many similarities. And then I'm using the heterogeneity in those samples, and the unobserved factors to capture the effect of natural resources on growth through transmission mechanism that we say it's being represented by the quality of institutions.
Yeah. I mean, one of the most interesting thing, Fred, about in the conclusions is that you say the required diversity threshold for not having the resource curves is given by 0.21. So you have some sort of a threshold. You say above this threshold, the marginal contribution of natural resources to economic growth is lower for a relatively more diversified regional economy than a less diversified one. So the policy implication is, as you say, that regional economies that are too diversified are the ones in which resource abundance is harmful to per capita income. So that is sort of counterintuitive, right?
Yes, it's counterintuitive, and you will also find that diversity itself in the paper is modeled, using 5 different indexes, and
Yeah.
these 5 indexes, vary across a wide margin. So when you look at the policy implications, you've got to really read those with caution.
Yeah.
Why? Why? Because in the modeling, we are trying to estimate a conditional growth model to explain what you see in per capita income variations. Not just that, we have also tried to use an interaction term between natural resources and diversity. So it is that single variable, the interaction term, that helps to identify whether diversification can influence or actually reduce the impact of the resource cost. So if you step back a second,
Yeah.
you will then realize that to the extent that those diversity indexes are highly, highly variable, there's a wide degree of variability, then you've got to really read the conclusions with caution, because of the sensitivity analysis reveals that they're highly sensitive to the construction of the indexes and other underlying factors, which are, of course, included in the technical portion of the paper.
Yeah. So let me ask you a qualitative question, Fred. I won't hold you to it. So yes, I just trying to look for your, sort of intuition. So after done this analysis, where do you come out? Is that sort of the threshold when you have very high diversification and rich abundance in natural resources, you tend to have lower economic growth. Does it sound right to you qualitatively?
Sorry, can you say that again?
So I'm just wondering where you come out, more qualitatively on this question. Is higher diversification a good thing or a bad thing for natural resource abundant economies?
I guess you've answered part of the question to the most part, because for a region that is highly diversified, then going back to say that it has a lot of natural resources, that means you are inferring specialization. So the major takeaway then is that before you go into the policy arena, before you start to look at interventions, based on this paper or related papers, it is important for policymakers to go back to the drawing board and take a snapshot of the economy over different time periods. You've got to look at structural dynamics. How has the structure of the economy evolved over time? It's not a one-size-fits conclusion or recommendation here. The most important thing that we're trying to gauge or say in this paper is that our approach, the modeling approach, helps to really shed light on the static versus dynamic impact of diversification. That's the major takeaway. When you see some researchers and scholars, they use models and techniques that focus a lot on the static components. Others have realized the need to deploy dynamic models, and that's why I really leverage dynamic panel models, the GMM, system MMs, to capture all of the dynamic aspects of the discourse.
Okay, so I guess the bottom line then, Fred, is there are a lot of moving parts, and so sort of the simplistic views of diversification and resource curves, or even the interaction between them, the simplistic views coming out of static models may not be appropriate from a policy perspective.
Fantastic. That's a very good way to summarize it. Yeah. And
okay.
One more piece, that despite the many flaws, of the basic theories and models that explain the theories that explain specialization, you find that while competitiveness in today's global economy is very key, opportunity costs remain a major driver of specialization. So at those days when you just close your eyes and say, oh, it's about diversification. No, you've got to really sit down and look at a wide spectrum, in your policy mix before you jump into conclusion as to what the optimal mix is going to be for a particular regional economy.
Right. Yeah, I mean, in economics, you can always find data that will prove or disprove any hypothesis you're trying to do. And
absolutely, it's all about the underlying the model and the assumptions.
Yeah.
It depends on what you are trying to really achieve. This is not a policy heavy paper. The emphasis really is on the techniques and the models, and to really explain the high variability, depending on the modeling techniques and the assumptions on the diversity indexes.
Yeah, I mean, I think it's really important, Fred, which is, the real takeaway is to make policy, we really have to think through many different things, and they're not static, as you say. They also show high variability. So any hypothesis testing that is based on some static set of numbers is not appropriate from a policy perspective. It is I think it's a very important thing, because we tend to do that quite often.
I agree, and that has it's why you've seen many pitfalls, in the whole policy design and recommendation spectrum. It is very important to know that when you are designing policies, of course, you look at your ex ante issues and the implications for ex post realities. But at the end of the day, there are always unintended consequences. And until you have like a general equilibrium type outlook where all of the pieces are captured, you've got to really be careful before you generalize or give a one-size-fits-all conclusion, about our economies.
Yeah, let's jump into another paper. It's entitled Gravity, Borders, and Regionalism, a Canada-US subnational analysis, in which you examine the extent to which trade costs influence the magnitude and direction of both East-West and North-South trade in Canada and the United States. You say with the aid of an alternative framework which pays attention to key estimation issues in the gravity literature, we garner further evidence and support of a decline over time in the home bias syndrome. So first of all, what do you mean by gravity here?
Yeah, that's interesting. Well, the gravity model is it's a popular model in international trade, which actually derived its name from the whole concept about Newton's law of gravitational attraction, right?
Yeah.
So basically, we try to extend that law in physics, to economics, whereby you say that the force of attraction between two masses is directly proportional to the product of their masses and inversely proportional to the inverse of their distance. So
right.
Take that law in the physical realm and extend it to economics. And then we like to say that the extent, the magnitude, of trade flows, between two jurisdictions is directly proportional to the product of their economic sizes, which in this case we like to proxy with GDP. Some analysts will use population, and inversely proportional to their distance. Of course, you look at it from an intuitive perspective that the further countries are away from each other, the less is the volume of trade flows that you see. So all that to say that physical distance and other forms of other distances that you can imagine, often contribute to commerce. Such distances could be language, colonial heritage, maybe same currency, and so on and so forth. The central model is a workforce actually in trade modeling that helps to really bring all of the pieces together.
Okay. So just like Newton's law of gravitation, you say the force is a function of the masses of the two bodies and the distance between them, the square of the distance, the mass is divided by the square of the distance. And it makes sort of intuitive sense to say there are the trade that you expect between two economies is proportional to the size of those economies, just like masses. And then it is inversely proportional to the cost of trade. And so, the simplest cost would be the distance between them, right? Further away they are, the more transportation costs and all of that. But like you say, the cost may represent a lot of other things like language, culture, style, GDP per capita that might proxy where the economies are in terms of development and so on. But generally speaking, it's the size of the economies divided by the cost to trade between them. That is what we see, right, in total trade.
That's very correct. So in essence, you are using a wide range of factors to model distance, what we also call trade cost. I think you capture that. Language, the presence of borders, contiguity, and so on and so forth. which is very intuitive. I mean, look at the volume of trade between Canada and the US, and compare that with the volume of trade between the US and, say, a country that is, in the global south. It's pretty intuitive. Of course, it's much more complicated when you start to introduce other nuances like multilateral resistance, counterfactuals, and other technical details. But in a very simplistic fashion, this is a model that has become the workforce, for really modeling how trade costs drive trade flows.
Yeah, so I want to really dig deeper into that, Fred. So Canada and the US, one of the articles here says interprovincial trade is 22 times larger than the state-province trade. And so what is interprovincial trade? This is trade between two provinces in Canada?
That's correct. Don't forget the framework for the paper. Again, it's a subnational framework. So pretty much we are really looking at Canada and the US, but not from a cross-country perspective, but rather we are focusing on the 50 states in the US and the 10 provinces in Canada.
Okay.
And let me step back a second and give you some context.
Yeah.
In terms of land mass, Canada is bigger than the US.
Right. But not a lot of people live up north.
Exactly. And for a country that is bigger than the United States in terms of land mass, just got about 33 to 34 million people. Compare that to the 33, 40 million in the US.
Right.
Another context here is the population and the economy of Canada is approximately the same as that of California. So, but in the whole jargon of gravity and modeling, you try to say that when you control for other factors like distance and other barriers, you want to be able to use the model to predict trade flows. And then before you knew it, John McCallum, was actually the guy who was a pioneer, and came up with the concept of the home bias in trade proposal.
Yeah.
That was a seminal study, that really came to explain the fact that trade between or among provinces in Canada 20 times higher or larger than trade with others when you control for other determinants of trade.
Yeah, so the trade between Canada and the US, if I understand this correctly, is 1/20th the rate of trade between two provinces in Canada.
It's nuanced. There are so many.
It depends on what province you're talking about. So this is sort of an average expectation, right?
Yeah, but the best way to capture this is you often look at provinces that maybe perhaps provinces and states that share borders. So in the West Coast, you try to look at a province like British Columbia, and compare what is happening with, say, Oregon or Washington State, and then you go to the East Coast, you look at, say, Ontario and New York or other states that are very close by.
Yeah.
So from a layman's perspective, you would think that if I can get an item in Canada, if it's $1 higher, am I willing to cross the border to get it in the States? But the point we are making here is there's always the home bias argument. It's not as simplistic as these models show, because before you probably leave Vancouver to go to Seattle, it's going to be much more than some marginal differential that will get you to cross the border, and that's what the home bias argument is trying to explain in a non-technical sense.
Yeah, so it's not necessarily a bias. Basically, it's saying there is a cost to trade across the border, right?
Exactly. Yeah. There's a cost, and those costs are not as simplistic as models show, because it's more nuanced. And even when we talk about the concept of a flat world, even if all borders were to disappear, there are still a lot of other nuances that would make a case for within country trade.
Right, and this is not an issue here between U.S. and Canada. Most of Canada, language also plays into it, right? So we would see very different things between France and Germany, I would imagine.
Yeah, absolutely, yeah. And this is a pretty universal model. In fact, when you talk about trade flows, between jurisdictions, it's perhaps like the first model that comes to the table because of the applicability, the relevance, and some of the major technical flaws, are well documented in the literature, especially multilateral resistance, heterogeneity, and issues around endogeneity, and once the proper models and techniques are employed, it seems to give a pretty good representation or reflection of what you see when it comes to predictive analytics and ability to simulate what you can expect in reality. And of course, the major focus, even though the paper is on Canada and US trade and the dynamics, I'm more concerned about the implications for equality, for inclusive development, growth, and what have you. That's like the natural extension for the paper.
Yeah, so I want to understand this. So you say in border effect, you say, while it may not be correct to conclude that borders constitute significant barriers to trade that should be removed, research shows that the intensities of economic exchange within and across borders are remarkably dissimilar for one simple reason. Economic linkages are much tighter within rather than among nation states. And so it is not just the existence of borders, it is really how business is done, if I understand that correctly.
That's fair. That's fair to say. It's fair to say, again, as you say it, when you start to control for cross-country differences, there's always that tendency to have certain factors within country, whether it be weather or the culture or institutional framework or other unobservables. Remember, when you are doing modeling, there are many factors that you cannot directly observe them. So you've got to then set up your model to look for some ways to capture those unobservable factors.
Right,
so
right.
The implication then is to the extent that a country is a sovereign nation with so many factors that are country-specific. All of those factors added together, explain why modeling distance, contiguity, international and international trade, it's a complex exercise. And to really depict reality, a lot of the models that help to explain those influences often have their drawbacks or pitfalls.
Right. And just very quickly, you find that I thought it was an interesting thing to think about. Bilateral distance reduces trade by 1.1% for every percentage increase in the distance itself. So just like gravity, we do find distance proxying pretty well to that cost of trade.
Absolutely, and in the whole modeling environment, when you calibrate your model and you start to do comparative statistics and the analysis, the first thing you try to test is the baseline model. You want to quickly look at the elasticities, and if for any reason they are not within range, then you probably have second thought to look at the model to see what might have gone wrong. So correct to say, the distance elasticity is a very important factor that helps you to gauge sensitivity and the robustness of models and related factors before you start to then extend the analysis to other factors of interest, maybe exchange rates or a new trade policy or other factors of interest. But very fundamentally, economic size and distance, you've got to really capture those at the baseline level before you extend the model to capture other factors of interest.
Yeah, so one of the important insights out of the paper is that when you look at Canada and the US, for example, one partner is about 1/10 the size of the other. The border effect is going to be more pronounced for the smaller partner. You say an estimated within country border effect of 43.5% for interstate trade compared to 1.92% for inter-provincial trade shows that the border effect is more pronounced in Canada than in the US. So, from a policy perspective, whatever policies are going to be put in place that might affect trade, Canada is going to be disproportionately affected by it.
Yeah, that's correct. I mean, that's correct. And the natural response to that is Canada is a small, open economy.
Yeah.
People often tend to think that the US does more trade than Canada. But if you look at it per capita, no. Canada is a trade-dependent economy. And because of its relatively smaller economic size, that means that you expect trade policy shocks to affect a country like Canada more disproportionately.
Yeah.
That even becomes more important when you look at how recent anti-trade sentiment and protectionism, how they have really impacted countries like Canada more than bigger economies. Because, again, the nature of small open economies are such that they are more susceptible to shocks, which tend to be very, very distortionary and in most cases have asymmetric impacts. So that's the point we're trying to make there, that to the extent that policymakers in both countries are trying to manage cross-border policy trade-offs, a small open economy has to be more conscious about the productivity differentials and other asymmetric shocks that may impact policy design and trade policy in general.
Right. Yeah, so I want to get into a paper that you're working on, Fred, that hasn't been published yet, and you're looking at trade globalization, related economic dislocations, and related social costs. Right. So you want to talk a bit about, we talked about trade and we talked about some of the models that might impact it, but more generally, how trade and associated costs impact society.
Oh yes, it's an interesting research. As you know, globalization and technological progress, have been largely blamed for much of the inequality that we've witnessed in the last 3 decades.
Yeah.
And the rapid pace of trade globalization and the income inequality that we've witnessed, those things have far-reaching impacts on economies and societies with huge social cost of adjustment. What I do in the paper is typically to look at the role of trade in the determination of long-run growth.
Yeah.
And it even becomes more interesting because the recent literature on the topic has extensively looked at the distributional implications. There's a paper, that I came across in the course of the research. It was released in 2018 by Oxfam. And one interesting finding is that 82% of the increase in global wealth in 2017 accrued to the top 1%.
Right.
And not just that, the bottom 50% witnessed no increase at all. So that really struck me, and you find that out of the many narratives that have emerged about the impact of globalization, the increasingly inequitable distribution of the gains from trade is one of the most pervasive. And the social backlash from this has resulted in the rise of nationalism and protectionist policies that we've seen. I also find in the paper that even though technological progress, continues to drive deeper market integration, we seem to have also seen two different narratives about globalization. And this has led to curiosity on which one is actually true. So my paper argues that the answer depends on the underlying assumptions, and the coherent system of ideas that we have advanced. So the central argument in the paper really is that the simultaneous rise of economic nationalism and digital integration, have introduced different complexities and pitfalls, even when you look at evidence-informed policy formulation and the central model, the data, the analysis tries to corroborate the view that the whole nexus, the trade inequality nexus, is a complex web of interrelationships, and they need to be disentangled before any policy conclusions, can be drawn.
Yeah, let me ask you on that, Fred. So we know that income inequality is a problem. It has continued to rise, and I don't know if one can attribute that to globalization. We can already look at things like you said, technological progress. Things like robotics, artificial intelligence, things like that have made certain skills um, less relevant or even not useful. In such a situation, we are going to continue to find sort of a segregation, right, between skilled and non-skilled worker. That's one issue in my view. The other is, 27% of the S&P's market cap today, S&P 500's market cap today is tied up by 6 companies. We've never been in a situation where you have a few companies with over $1 trillion in market cap. Typically, when you see that, you would think about market power, monopoly laws, things like that. But we haven't really. And so if we let that go, it's a bit like a gravity problem. You have one mass becoming a black hole and it's going to eat everything else that might get any close to it. But I don't know if it is truly related to globalization, though, Fred.
That's very interesting, Jill. You raised an important point, and it gets me smiling. Yeah. So because of my research, I took the time to really look at a book by Branko Milanovic.
Yeah.
He wrote a book in 2016 titled Global Inequality and Globalization, or something to that effect,
Right.
And in the book, he again explains the dynamics of trade, globalization, and inequality. And the interesting thing in that book is that it argues that, of course, the periodic increases and falls that we have seen in inequalities over the years, they're often driven by factors like technology, disease, war, education, and redistribution, with the conclusion that inequality will not actually grow in perpetuity. So what does that mean? I mean, look at what COVID-19 has done.
Yeah, absolutely.
So that's a typical, that's an example of how war and disease can trigger inequality. So why globalization, of course, happens to be one of the contributors. It is not the sole driver of inequality. It's partly correct, though. You can partly say that globalization limits the effect of maybe the tools, the traditional tools that we have known, redistributive tools that can help to raise welfare and promote inclusive development. But again, policies have to recognize region-specific nuances. Right. So my conclusion is that trade may expose economies to international competition, which of course would then lead to disproportionate outcomes, which makes stabilization policies to result in asymmetric shocks which can reduce the size of the income gap. So we can't blame trade or technology as the sole factors. It's a wide variety, but again, the devil is in the details. You have to look at regional specific issues before one can jump into conclusions.
Exactly, yeah. I wonder, Fred, I don't have an answer to this, nor any research, but I wonder if there is, if a thought experiment would be, suppose we have 100% globalization, meaning there are no countries, there are no boundaries anymore, all 8.5 billion people are together. So that's scenario one. On the other side, another extreme, you have zero globalization. Essentially everybody is for himself or herself type situation. Um, I wonder if in the middle, sort of globalization is what we have today. Countries fight with each other. When you have a shock to the system, they try to ring fence resources. They don't share information like we had in the case of the pandemic. That's all sort of in the middle of that spectrum where we have, quote unquote globalization, but we don't really. And I wonder that is the worst outcome in the spectrum.
Yeah, I mean that's an interesting perspective. It's an interesting perspective, but I also think that it is important to look back, and look at history.
Yeah.
Because what you've seen in recent times, in order to really make sense of what's going on, it's key to look at history. You realize that. Let me go back a little bit. You find that the dominant model, in 19th century classical political economy was really based on the notion of the constant wage law or constant wage share law, which was propounded by the English economist Arthur Bowley. And that model supports the notion of a constant labor compensation, total output. But what have we found since the post-World War II expansion, which heralded many changes in the patterns and processes of capital accumulation?
Yeah.
Especially with many of the highly dynamic capitalist countries. And the other thing that can help the thought process is like the past two recessions in the US. I mean, they have brought about significant declines in labor's share of total income.
Right.
You see that economic activity has gradually moved from small labor-intensive businesses to large capital-intensive firms.
Right.
And while this shift has been one of the key drivers of income and wealth inequality over the years, I dare to also say that the fall in the share of labor in output is often not within a typical firm, as most people would think. Instead, what you see is that this has been a steady and gradual reallocation in favor of the big capital-intensive firms. And that has led to the emergence of superstar firms with huge market power in dominant and strategic sectors of the economy, which you rightly alluded to, with the S&P and other metrics that you saw today.
Yeah. Yeah, that's exactly right. Yeah, but if you believe that the labor share of output will continue to decline because of advancement of technology, then it is really up to policymakers to think about it systematically, right? One is thinking about monopoly laws and things like that, and the other is really thinking about, in my view, universal basic income, those types of policies, because that train is going down the track and it's accelerating. And so, the real question is how do you, like you say, redistribute from a policy perspective? But we're not spending a lot of time on that, I think.
Yeah, I mean it's fair. It's fair to say, and that's a very nice. It's a nice departure, from the conversation so far. So far we've really been looking at the theories, the models, and and the frameworks. But the question you just asked brings us to the whole notion of inclusive development.
Yeah.
Maybe I can start by quickly explaining what inclusive development is.
Yeah.
It is a concept, that really emphasizes the need to approach well-being from a much broader perspective. Because without doing so, it will be very difficult to focus on marginalized populations and those that are really excluded.
Yeah.
It will be hard to address wealth concentration and a polarized labor market where you see growth happening everywhere, but wages are disproportionately concentrated. And permit me to bring my organization into the conversation.
Yeah.
At the New York City Economic Development Corporation, that is exactly our mission. So we are a nonprofit organization that creates shared prosperity across New York City. Our projects and initiatives are really about serving New Yorkers. We work with and for communities through every step of the economic development process.
Yeah.
And in the process, EDC brings new and emerging industries to the 5 boroughs. We create spaces and facilities that they need to thrive, to create jobs. So giving New Yorkers the tools and training to succeed in those jobs. We also do invest in the public infrastructure and neighborhood development projects that make the city a great place to live, work, and do business. So in summary, our work at EDC is really about creating a sustainable and resilient future with shared prosperity and opportunity for all New Yorkers. And what does that tell you? That tells you that beyond economic growth, inclusive development really underscores the need to consider the distribution of social goods like health, education, and infrastructure that people really need to move up the economic and social ladder. And that's to the extent that policy intervention, comes into this conversation. So that really puts me in that triangle of leveraging theories, models in the academy to see how we can advance the policy agenda to help vulnerable people, marginalized populations, minorities, women, and other traditionally underrepresented communities. That's from a policy perspective.
Yeah, that is well said, Fred. So sustainable and resilient economy and inclusive development. So that, really that is the tool. And, whatever New York does, it's a nice little scaled experiment. So if you are successful there, you can take that model and replicate that. Fred, thanks so much for spending time with me, and good luck with everything that you're doing in New York.
Thank you very much, Gill, for having me. Good job you are doing there. Keep it up, and ready to be part of the conversation. Appreciate it.
Thank you. Bye.
Take care. Bye now.